Welcome to CrushTheStreet.com's weekly market wrap-up. Let's begin in the U.S. equity sector, which ran again flat heading into the final stretch of the week. Despite an earnings blitz that featured several top names including Apple and Facebook, the benchmark S&P 500 closed a hair above 1,878 points, a 0.2% move, while the Dow Jones Industrial Average ended at parity against the prior session, closing at 16,502. The leader of the major indices was the Nasdaq, which started the day strong, moving up over 1% before halving those gains, eventually closing at 4,184 points. Positive results from Apple, which recently announced the 7-for-1 stock split, did little to affect the trajectory of the broader markets, with the Ukrainian crisis on the verge of another violent escalation. Belligerent statements by Russian President Vladimir Putin, in which he blatantly accused the internet of being a CIA project despite Russia's own expansion of domestic surveillance networks, according to Andrei Soldatov, an expert on Russian surveillance culture, did little to mitigate geopolitical tensions, with the cryptic nature of his statements sending shares of the Yandex, the Russian equivalent of Google, to a 5.5% loss.
Now, I've seen little public discussion of Russia's own involvement in the policies of mass surveillance. So I'd like to ask you, does Russia intercept, store, or analyze in any way the communications of millions of individuals? And do you believe that simply increasing the effectiveness of intelligence or law enforcement investigations can justify placing societies rather than subjects under surveillance? Thank you.
Mr. Snowden, our intelligence efforts are strictly regulated by our law, so how special forces can use this kind of special equipment as they intercept phone calls or follow someone online, and you have to get a court permission to stalk a particular person.
In turn, both gold and silver turned up in the middle of the week, buoyed by anticipation of further unrest, while palladium regained the $800 mark. Meanwhile, the price of the digital currency Bitcoin has been on a strong recovery, hitting $493 in the last session. Domestically, industry participants are steadily absorbing the reality that year-to-date, the equity sector has done little to more than to secure a footnote in the annals of the stock market history. Now the million-dollar question is whether this is enough to move momentum forward or if we are headed towards a sizable correction. CNBC contributor Michael Santoli wrote an op-ed earlier this week comparing the similarities between market dynamics in 2014 versus the tape of 2005. In particular, he noted that the large cap equity indices absorbed hefty gains following a bounce from the bursting of the internet bubble, and 2005 was marked by indecisiveness. Further expounding matters was Google's astronomical rise of over 400% against its IPO, which occurred only a few short months ago in August of 2004. This led The Economist to headline an article entitled "The Echo of a Boom," which mirrors bearish sentiment currently expressed by alternative media sources and select offerings from the mainstream. But the similarities don't end at mere conjecture. By Memorial Day weekend in 2005, overheated tech stocks fell by as much as 12%, while the broad market remained relatively stable. So far this year, the tech-centered Nasdaq is a clear laggard amongst the major indices, with its fortune changing abruptly in the first week of March. Tellingly, its chart pattern is dramatically different from the S&P or the Dow, displaying what could be described as an aggressive broadening wedge, a rare formation recognized by technical analysts as having substantially bearish implications. Another parallel is the action taken by the Federal Reserve. In 2005, the Fed was reining in easy money stimulus that it had administered following the market breakdown near the turn of the century. Then Chairman Alan Greenspan signaled his intent to retire, leaving Ben Bernanke to carefully oversee the rate lifting process. The connection with Bernanke's decision to exit front and center after negotiating the wake of the 2008 crisis is perhaps more than coincidental. What does this mean for the future? While history doesn't always repeat itself exactly, we are all too familiar with the stories of those who choose to willfully ignore it. And that'll do it for today's edition. Thanks for watching, and we'll see you next week.